Want to keep more cash in your pocket and build wealth in real estate? Well, today we're going to go over 5 powerful tax hacks that most investors miss. So let's go ahead and jump right in. The first one I want to talk about is cost segregation and bonus depreciation. So instead of getting a residential property and depreciating it over 27 and a half years, or a commercial rental property and depreciating over 39 years, what you can do is you can break that into different components that are based on 5, 7, and 15 years, such as AC, carpeting, plumbing, different components of the house, and then you can depreciate those assets on a much smaller term. So what does it mean? That you can depreciate them faster. But what's the kicker? The kicker is once you take those components and move them to the other buckets, then you can actually use bonus depreciation for those buckets and depreciate a lot of that all in year one. So that's really great for savings in your pocket for cash flow. So to me, it's a no-brainer. For rental properties, whether they're residential or commercial, always get a cost segregation analysis. There's many CPAs that specialize in this type of work, and it doesn't cost that much money as compared to the amount that you can save. I want to go through one example. So if you were to buy a residential rental property for about $500,000, excluding the land portion that's not depreciable. In year one, you would normally have an $18,000 depreciation deduction for that property. However, using cost segregation analysis, you could have $80,000 to $120,000 in first year depreciation. So who does that benefit? That benefits any taxpayer that actually has other active income that they can offset against the bonus depreciation. So you're going to want to consult with your CPA to see if that's something that's beneficial to you. Obviously, if you don't have income to offset against it, maybe it may not matter. However, if you do, this can be a tremendous amount of tax savings, which just means more cash in your pocket. Tax hack number 2 is 1031 exchanges. This comes from the Internal Revenue Code that allows you to sell an investment property and roll that gain over into a new investment property, therefore paying no capital gains tax. Actually, a deferral of tax that you would have to pay later, and in some cases, indefinitely, you won't have to pay any tax, and I'll explain that in a minute. So one of the things that you're gonna wanna know is you need a qualified intermediary. So you want somebody who's a professional that deals with 1031 exchanges, that you hire, that keeps you on track with your dates, make sure you're in compliance with the Internal Revenue Service rules and regulations, and make sure you hit your marks, also tracks your basis for you. We have a great intermediary that we work with, and he's been doing it over 20 years. He's excellent, stellar. If you want his information, contact us. We're happy to share that information. Another thing I want to mention is you get a stepped up basis at death for estates, and therefore a lot of times there's no tax paid at all. So if you hold the property indefinitely throughout your entire life, then there is a chance that you will not have to pay any tax with a stepped up basis at death through your estate. So that's one way that people really build a lot of wealth and avoid taxes. The only way you have to pay tax is if you were to sell a property and not do a 1031 exchange. In the future, then you would have to pay that tax at that time. Great benefit, great tax savings, done every day. Very, very popular amongst the real estate investing community. Tax hack number 3 is deducting expenses for out-of-town rental properties. So many people miss these expenses. So if you're gonna travel and you have a rental property that is in a different state or even just not local to you, and you're gonna be going to check on the property, you can write off your flights, you can write off your hotels, your gas, your mileage. I mean, there's all kinds of things you can write off there. You just wanna make sure it's documented as a business purpose expense trip, and all of those expenses are deductible on your taxes. Tax hack number 4 is hire your family. So you can hire your family, your kids, or your spouse for all kinds of stuff, for cleaning, property checks, also maybe they're in your marketing. So you can hire them and you can pay them a fair wage for the work that's being performed. That becomes a deduction to you. In a lot of cases for the kids, there's no tax to be paid because of the fact that it's under the standard deduction. So if they don't have enough income to cover the standard deduction, there's going to be no tax on their end. So that's another tax hack that everybody loves. So hire your kids, hire your spouse, and write it off. Tax hack number 5 is real estate professional status, also known as REPS. REPS is an IRS designation that allows you to deduct your rental losses against active income. In order to qualify, you or your spouse needs to perform more than 750 hours of active participation in real estate professional work. So you want to check with your CPA, make sure that you qualify for this. However, if you do, you can deduct rental losses and they're not limited. And you can deduct it against your active income from W-2 wages or other businesses that you might own. Combine that with cost segregation analysis and bonus depreciation, and this is like the holy grail of tax strategies. So if you can qualify, or your spouse, as a real estate professional, this can give you huge tax advantages and can potentially even eliminate your tax liability. So real estate investing isn't just about cash flow and appreciation. It's about tax strategies. And by using these 5 tax strategies, you can keep more cash in your pocket, which gives you more money for your next deal. So if you like what you hear today, like, subscribe to our channel, and drop a comment below. Let me know what tax hack you plan on using this year.